Ticker RDTE is the newest fund from RoundHill that pays weekly dividends. This one is the small cap 0 DTE covered call strategy ETF. And today we're going to be talking about how much money you would make from the distributions every year if you invested $10,000 based off of their previous payments. If you guys are interested in these weekly paying dividend ETFs, I've started a new account where I'll be investing money into each of them and tracking their progress. And I'll link that video down below and at the end of this video for those of you that are interested. There's now 8 of these funds that are paying weekly, which is absolutely remarkable. I love the weekly payers. So today we're going to be talking a little bit about RoundHill, the first 2 payments, and then we're going to talk about that calculation to see how much money you'll make owning this. So if you guys like this type of content, if you like dividends and investing and ETFs, don't forget to like and subscribe. It helps me out a ton and it helps me grow the channel. So with that being said, let's dive into RDTE, talk about this fund, and talk about how much money it's going to make us. Back on the RoundHill website, one of my favorite websites. I think it's beautifully done and easy to navigate. And so that being said, RDTE, what's different? Why is it different from QDTE and XDTE? Well, it's the same strategy. We can see it's still the 0 DTE covered call strategy, and we'll check their fact sheet and I'll explain how that works again and what makes these ones unique, although not as unique as they used to be. But what's different for the R is the Russell 2000 index. That's the index this one is riding its covered calls on. And so one thing that is beneficial when you look at this index of the Russell 2000 versus XDTE's S&P 500 and QDTE's NASDAQ 100, I believe. I might even have those switched. But one benefit to this is the fact that the Russell 2000 is small caps. And so if you aren't familiar with all the different indices, the small cap stocks are a certain market cap. They're below a certain market cap. So it's not these huge companies. It's smaller companies, although relatively some of them are still pretty large. And so what that means is when they're writing these 0 DTE covered call strategies, you have typically a little bit higher risk. There's a little bit higher volatility, and so that makes the premiums better. That being said, the Russell 2000 index has underperformed both the NASDAQ and the S&P 500 in the last 2 to 3 years. So price appreciation wise, it's not looking quite as good, but the dividends should be a little bit better. And that is completely assumptive. We don't know for sure. We can see all the benefits, weekly distributions, income potential, and harness volatility. And I'm going to go to the fact sheet for just a second here because they have a really good way of explaining how these 0 DTEs make sense. Now, assets under management, this is all old. It's not 0.8 million yet. And the expense ratio, that's pretty typical. We've seen that for almost all of these funds now. But that being said, how the strategy works. So each trading day, the fund will sell a covered call against its position within the index. And so one thing that's different than these are not synthetic covered calls. They own the index. They buy the money. They use the money to purchase shares of the Russell 2000. Seeking to generate options income, daily returns are capped at the sold strike. And so they're picking a price during market hours saying, oh, if it goes above this, I'll sell. When it doesn't, you net that premium. And if it does, they sell, but you still have the premium that was made and then paid out. So then they have to reinvest. So the goal is not to hit that sell price. They just want to net the premiums over and over and over again. And the more volatility there is, the higher the premiums will be. Now, the overnight is a long only position, meaning they're not writing options that go from day to day. And what this enables you to do is, because there's no option positions, you have, they say, full exposure to the index. So whatever happens in the after hours market, either pre-market or after hours, if the fund goes up, you net that profit and the fund will mimic that. And if it goes down, the exact same thing. And so this matters depending on if you have a lot of faith in the underlying index. And like I said, with the Russell 2000 underperforming some of the other ones, this one would probably be, for me, a more dividend focused rather than a long-term position for price appreciation. And so that's what they say on here. And it makes a lot of sense. Now we'll X out of this. We'll go back to the website and check out some of the information on here. The main thing I want to look at, their assets under management, that's what AUM stands for, is now 32 million. No point there. 32 million. 730,000 outstanding shares. Actively managed, of course. They have to write these daily options, and that's why the expense ratio is so high. Top holdings, Russell 2000, which is about 89%, meaning they do still have some in cash. You can go on here and see their trades and all this. That doesn't reach out to me as much. We haven't seen a lot of return. They have seen I mean, we haven't seen a lot of time for return, but they still have returned 7.44% since the inception date, which is pretty remarkable. And distributions. So this is their calendar. Their next one, it'll declare on the 9th and be paid on the 10th, but we have gotten 2 so far. So one was paid on the 27th and one on the 4th. The amount paid was 36 cents and then 38.5 cents, which is pretty good. Now what I'm going to do, I'm going to run the numbers, calculate a rough yield that we'll actually use for our next calculation, but these are decent. We can pull up some of the other ones and see what the other yields are and what they've been making, but I'm happy with this starting yield for this fund for sure. I'm going to look at XDTE's payout history just to compare it to the first ones for RDTE. And this is on the S&P 500. For those that aren't familiar with this fund, I have a bunch of videos out about this one as well. Assets under management a lot bigger at 157 million. But we can see their distribution history. 22 cents, 18 cents, 20 cents, 33, 31, 26. So again, all over the place, all the way up to 41, which I believe was the highest. There's so many already paid out because it does pay out weekly as well. But still, a lot of volatility in the market has some of these being huge, some of them being a bit smaller. But RDTE, I would say, is in the top, probably 70% of these payouts so far, which I like. And again, it was expected to have a little bit more volatility, meaning a little bit higher premiums, but also higher risk. So let's look at QDTE. For QDTE, we see a higher distribution rate of 31.31%. And this one's on the Innovation 100, which is the NASDAQ 100. They didn't include that because you have to charge for the name. And so they actually don't have to pay for the name. And so distribution history, we can see roughly the same as maybe a little bit higher, a couple in the 47s, 50s, all the way to almost 57 cents. So higher distributions, which makes sense because the yield technically is higher according to them, for QDTE over XDTE, and even more than RDTE. But again, we've only had 2 payments so far, and they do range 25 cents, 20 cents, 19, up to the 50s, back to the 30s, the 20s, and even a little bit lower. Not bad so far. I have videos on the returns of these so far, and we'll definitely be able to track the history with that other account that I'm doing with that new series on investing in all of the weekly paying dividend ETFs. So let's go back. Let's find the yield of RDTE. To calculate this out, what I'm going to do is I'm going to add our dividends together. So it's a 0.386265. We'll do all of it just for fun, plus 0.360323. And so that is going to equal 74 cents. We're going to then divide that by 2, which gives us roughly 37.3 cents. And we're going to multiply this by 52. Now I'm doing this, there's 52 weeks in a year, a little bit over that actually. And so by doing this, this should give us a rough estimate of what we're going to get paid out the entire year, which is $19.14. Now if we scroll back up, so we'll switch over. We can see that the price is 44.12 cents. So at $44.12, we're going to take 19.411 and divide it by that number. 44.12. And that's going to give us this number that will then multiply by 100. So this gives us roughly a 44% distribution rate, which is pretty remarkable. I mean, that's really, really high. It is, I don't know if it's going to stay like that. No one's able to predict it, but a 44% yield is phenomenal. And I expected this one to be a little bit higher. And the 2 payouts so far, again, this is a rough estimate done by me. It's not official. It's not what they're saying yet. I will wait and see what they say. But that's insane. That's a great return. I'm super curious. I've already got a great return from the fund, especially with price appreciation as more people fund their accounts for this one specifically. But still, I'm pumped with that. Let's do our calculation, see how much money you'll make every single year with a 44% return. So before I start this calculation, this is very, very assumptive on my part. I calculated my own yield, which I believe is relatively close to accurate, but we do not know what the price appreciation or depreciation is going to be with this fund. There could be some heavy NAV erosion like we've seen with some other funds. We have no idea. So I'm taking that out of the equation because I simply can't predict it. And even though we have seen this one return roughly, 7% so far, there's still a chance that it goes down in the near future. So pulling all of that out of the equation, always do your own research. This is not financial advice. I always like to say, this is an assumption. Don't come at me and say this is going to happen or isn't going to happen in the comments. I know it's an assumption. So at 1 year, I've already put in all the numbers. We can see we have a weekly distribution frequency. We have DRIP on. And I've seen a lot of people saying not to do DRIP with these funds. which I'm interested in. Let me know what you guys think. Should we not do drip? Should we do drip? I'm really, really curious if people are using drip or not because NAV erosion. But our $10,000 at $44.13 gets us roughly 226 shares. And at the annual yield that I calculated of 43.99%, I'm not including taxes. I'm not including any of that. And there's no annual contribution. At the end of the first year, you will have a total return of roughly 55%. And now I know you're probably thinking what I thought initially was if you have a 44% yield, how do you end up with a 54% return at the end of the year? Well, that is because of the weekly distributions with drip. And I've seen people say that, no, the weekly distributions don't make a difference, and they do, because I've explained it in a couple other videos, and so I'm not going to do it again. I'm just saying it does make a difference. If you can prove me wrong in the comments, I am welcome to it, and I'd love to be educated on it. But as far as I know, and based off all the math that I've done, it makes a big difference, especially over time. So that's how the yield ends up increasing. And so your annual dividend income, $8,518, which is phenomenal. And dividends payments over the full 1 year is $4,398.94. So we're going to kick this up to 5 years invested. So at 5 years, at the end of 5 years, your ending balance is now roughly $90,000. Total return is just under 800% with an average return of, again, 54%. Now, your annual dividend income is $49,000 after 5 years of this insane growth. And your total dividend payments over the last 5 years is $63,520, which is insane. I'm going to kick this up again. We'll go to 10 years, not too far. And again, who knows what this will do. Your ending balance at 10 years is $800,000 with an average, an annual dividend income of $440,000. That is an insane amount of money. And that is the power of drip. And I'll take off drip at the end and rerun the calculation and show you guys how different it makes it. Total dividend payments over 10 years, $631,000. I'm going to go ahead. I'm going to jump straight to 20. We know it's going to get absolutely insane. Almost $64 million at the end of 20 years invested. So your annual dividend income becomes $35 million, but drip is still on. Total dividend payments over the 20-year period is $51 million. And so I love to throw this scenario at people. Let's say you're 25 now and you want to retire at, 55. So you invest $10K into this fund. It trades sideways. There's no price appreciation, no depreciation. You don't put any more money into it, and you just leave it. And it compounds and compounds and compounds over 30 years, which, again, is very unlikely. At the end of 30 years, you have, $5 billion. $5 billion. Total annual dividend income of $2.8 billion, and over the 30-year period, you have $4 billion in payments, which is absolutely insane. Absolutely insane. So that's this. Let's go ahead. We'll turn off drip. So we'll just do 1 year to show how drip works, not 31. Let's do one total year. So back to 1 year, dividend payments over that 1 year period, $4,398.94. If we switch this to monthly, it took my brain a second to comprehend that. So monthly, we can see, I'm going to go back to weekly. So your ending balance is more with weekly, not by much. Again, it's only 1 year, so it doesn't make a huge difference unless you have a huge amount of money invested. But also, your annual dividend income does go down from, what was that, $8,518 to $8,532. So if we kick this up and we go to 5 years, 5 years of weekly, ending balance $89,373 compared to the monthly $86,007. So although it's, $3,000 out of $80-something thousand is not a huge percentage, it will make a difference. The longer you go, the more years you go, and the more money you have invested, of course. So, because that's the power of compounding interest and compounding your money. So I hope you guys did enjoy this video. If you did, again, don't forget to like and subscribe. Helps me out a ton. Check out our other series on investing $100 into every single weekly paying dividend ETF. And if you're interested more in those, leave a comment as well, and I'll keep doing weekly updates. Thank you guys so much for watching, and I hope to see you in the next video.